So a tax depreciation report is a report that we give to owners of investment properties that they will then forward to their accountant. Their accountant will use it in their annual tax return as part of their whole assessment to pay less tax, essentially. So it's hidden cash flow that investors don't necessarily know they're going to be able to get, but the legislation, the tax rulings allow investors to claim the theory of wear and tear as a tax deduction. So within all the tax rulings, there's a ruling which says accountants, valuers, real estate agents and a few other professionals aren't actually recognised by the tax office to estimate historical construction costs, whereas quantity surveyors are, and we're a quantity surveying firm, so that's why the tax office prefers quantity surveyors to do the depreciation schedules. So that changes depending on the property. So obviously there's a wide range of properties that people are investing in. If we're talking like a brand new construction, somewhere around a $350,000 purchase price, there's somewhere around $6,000 to $12,000 per year for each of the first 5 years as a tax deduction. And then it all depends on what the marginal tax rate is of the owner of the investment property to work out exactly what that means in cash terms. But in deduction terms, it's somewhere around $6,000 to $12,000 per year. And then we obviously go to a whole lot of different properties as well. And it goes right down to ex-housing trust homes, which we still get a few $1,000s worth of depreciation on. So every property is a case-by-case basis, and there's no hard and fast rule for any depreciation deduction. But as a general rule, the older it is, the less depreciation there is, but they're all still worthwhile getting a schedule done on. Yeah, so if the renovations are quite significant, I would suggest that it is worthwhile getting another report on. You are going to be able to claim the depreciation on all those additional works. By giving us the costings, we should be able to work out the new schedule, and then obviously we'll pass that through to the accountant as well. The important thing with that as well is that a lot of the time when you're doing new work, there's a chance that you've potentially thrown out or scrapped some of the existing items that were in your income producing property beforehand. When you do that, there's a chance you can claim all the leftover value of that item immediately when you scrap that item, for instance. So with all of that, it's important just to let your accountant know what you've done with your property. Yeah, so pretty much for all the reports we do, we go out on site and we'll measure up exactly what floor coverings there are, so how much vinyl, how much carpet, how much tiles. Same with whatever window coverings there are, blinds, curtains, and then exactly how many smoke alarms, what sort of appliances you have, how old the hot water service is, air conditioning, heating. So we do a thorough inspection and detail every single element of the property. We also take quite a few photos as well. It takes about 20 to 30 minutes generally on a residential property to do those inspections.